I'm going to be going over the 2026 IFVG trading model from Dodgy. Go and watch his video. I personally like the old model, so I'm interested to see what he says. So this trending IFVG model I found was the best. So let's say that's a 5-minute fair value gap. That's a 1-minute IFVG. And you get this impulsive move up compared to say like a reversal IFVG model, so a high time frame PD array. Then you get a stop hunt, and then you get like an inversion fair value gap here. And then you enter at the close. And because you're moving your stop loss at break even, a lot of the time you would get stopped out at break even before the move actually happens. So it can sometimes get frustrating, this model. So I'm hoping his 2026 model changes that. So let's go over and watch it. This is the first time I'm watching it myself.
I've been getting a lot of questions saying, Dodgy, has your IFVG model changed with these recent market conditions? Without any BS or long intro, let me break down my new way of trading IFVGs in 2026 and answer that question. Has my model actually changed? Okay, so the main model that I teach that you should all know, if you're new to this video, okay, you're about to learn something, is a delivery from a fair value gap, which is going to be this yellow zone, a liquidity sweep. So generally we're downtrending, we sweep below inside of fair value gap, and then we get some sort of inversion fair value gap back to the upside. If you don't know what an inversion fair,
so that's pretty much what I explained with this one here. So this is like the reversal model, high time free PD array, a stop hunt, liquidity sweep, and then an inversion fair value gap. So that's what it's describing right now.
fair value gap is, there's a lot of PDFs out there or pictures that just explain it. So maybe it's an Asia low, maybe it's a news low. Yes, but no. Okay, I am looking for a lot of other confluences lately because of how bad price action's been. So just because we get an IFVG here does not mean I'm entering the trade. I'm actually adding stuff. So I'm adding stuff like looking for maybe an order block at the same time. So maybe there's an order block we also bounced off of, or maybe we put in, or maybe there's a CISD or something along the lines of that. Okay.
I've actually noticed that too. Where price action, especially when it's like a week before FOMC, you do get a very choppy price action like this, and you can't be really accurate with the entries as much. So I'm guessing he said he's looking for an inversion fair value gap with an order block, so something like that. You get more accurate entries, possibly. Let's see what he says.
And the number one thing about this model is I always make sure there's still an amazing draw on liquidity. The number one draw on liquidity I have used in the past year probably is the trend line liquidity. I love this. Okay. When we were building lower lows and lower highs, we put in a trend line at about a 45-degree angle. And I love targeting these leftover stop losses or these leftover trend line liquidity. I noticed this year alone, this is the bad price action, and this is where people are getting wrecked. And I'm entering a lot of trades where after people are getting wrecked and getting off the charts when we run the trend line.
But the thing with NQ is those low resting liquidity can last for quite a while, and it often traps people. Like on Friday, there was a similar price action. So you see what he's describing here. So all this low resting liquidity. So when an IFVG happens, say around here, a lot of people will go long here and say their first target stop loss at B is around this high. Because there's low risk and liquidity, people think, oh, this is really good draw on liquidity right here. And it's probably going to go much higher because we're near all-time highs. And then NQ just reverses on them and takes them all out and wrecks them, leaving even more resting liquidity. So It can sometimes trap you.
Okay, so let me just explain this to you. All right. So right now, the market is just pump and now we're dumping again. But what did you notice we had formed? A trend line. Okay. Earlier, it's kind of funny. Earlier, we had a 15-minute inverse right here off of a monthly fair value gap. Okay. There's a monthly fair value gap we tapped into today at the time making this video. And you can see it's right here. Okay. So here's our monthly fair value gap. It's pretty obvious. And earlier, I saw the 15-minute coming out of the monthly. However, we ended up hitting this high and then retracing all the way back down just to form bad price action and trend line, which is where people get wrecked. So where do I enter? Well, there was a textbook 1-minute entry right here. Okay. And I love this entry because you can see all these people are getting wrecked in this chop. We leave all this liquidity up there, okay, including, you know, a bunch of relative equal highs such as here. And I'm entering at a pretty discounted area right here. And a lot of my students just enter this, funny enough, in my chat. And we're still delivering from, you know, this low here. And then you can see we tapped into a fair value gap right here. It's pretty small, but it's still there, okay? Whenever we form a bottom, I always look to the left to see, like, are we bouncing off of anything, okay? So pretty obvious here. But again, I'm still targeting that trend line idea from, you know, where I think price is going to go, okay? Same thing with last night during London session. People are getting wrecked here. People are getting wrecked here. Boom. We trade outside of that channel where people are getting wrecked inside this channel. So we trade outside of it. And then massive momentum candle back to the upside.
Interesting. This model is a lot more complicated for beginners, definitely. This is why trading is hard to make it mechanical, because you're not always going to get the best conditions in price action. So like when the price is in a nice channel, it's more predictable. But as soon as you get some impulsive move out the channel, it can scare a lot of traders out.
Where we have so many built up stop losses, it's literally insane. Okay, look at how many stop losses were built up in form of a trend line here, okay, which is going to cause that domino effect for us to run that trend line, okay? And a lot of my setups these days are waiting for that trend line run, okay? The setup
Interesting. He's almost using the channel. He's almost using a channel as like auction market theory, where it goes outside the value area, and then once it goes back inside of the value area, then you expect a reversal. But he's doing it using a channel, just because the price action is a lot more difficult than
I took
usual.
today during New York session was a short, okay? The short I took was this short right here when we completely dumped through that fair value to the left. And you're probably wondering, like, why am I taking this? Well, because we had the engineered kind of trend line with 2 touches, okay? Right? We have engineered liquidity down here. If it looked like this, and let's say this was a London low, all right, let's say, you know, this happened to be a London low right here. You're like, oh yeah, dodgy, London low. I'm going to target that. Maybe 2 years ago, but in these markets, I would really try to focus on, targeting the engineered liquidity instead of just any random London low. So ideally, you want to combine like a London low with a relative equal low, or an Asia high with relative equal highs. That is going to be better than just targeting an Asia high, which I did, a lot more 2 years ago. So looking for the engineered liquidity, right, and
Wow, that was actually super interesting what you said. So looking for confidence. So like one of my favorite indicators is like the session, because it marks like a lot of liquidity. Let me delete everything here. So that's like a London low here. So he's saying if you're targeting a London low, you want something else to be there as well. So in this one we have not only the London low, we had that low there, but also the China low was there as well. So 3 draws on liquidity quite close to each other. So once you had that inversion fair value gap, t- 10 a.m., then you would target those lows. So yeah, it shows trading is very difficult to keep
Entering
mechanical.
off of good momentum, such as a death candle or a birth candle, is the biggest change that I've made. I'm barely entering off of choppy closes. Okay. Now, there is sometimes where we are choppy in a fair value gap like this, and then all of a sudden a giant momentum candle goes like this. I will still enter those. But the closes where we're just kind of
Interested. Let me write these down so I'm keeping up with all his new models. So draw liquidity confluences. Example, session lows plus high time frame equal lows. That's just an example, but there could be a lot more. And he's saying don't enter at choppy IFVG closes. Look for death candles. So like really impulsive closes, because then the market has a lot of momentum to play out.
going like this, I'm pretty much staying away from unless it's like a light bulb candle. So that's just me. Now, last Friday, I took a 1 minute or a 30-second short right here. And I will say one thing, a lot of my trades are during 9:30 to 10 more than they ever were. Okay, I used to trade a lot more like from 10 to 11, but in these markets I'm catching these like beginning false moves right off the market open. If you don't know what these are, it's basically a Judas swing. So a Judas swing, which has been part of my model big time lately, is when we have a 9:30. Okay, this is where the market likes to open. Not likes to open, it will open here. All right, and essentially we'll get an opposite move, sweep a high, and then we'll get a liquidity sweep right here, and then an IFVG to the downside. So a lot of my moves have looked like that, especially off 9:30, which I love. So but
I do like those too, but I found that off the open it can like do both ways. So it's like safer to wait till like 9:35 after that opening time window is closed, because what can happen is price action can do this, can do like a Judas swing here, a Judas swing here, and then go the opposite direction. So you could be a short from here thinking, oh, you're good because of this impulsive move, and then it reverses on you. And it can do that twice on choppy days and catch everyone out. Sometimes you're better off hedging if you've got like a forex prop firm.
it wasn't like that in 2024. We didn't not get that every day. I feel like at least 3 times a week in today's market we're getting that. Okay, but you can see here, same thing. We go sweep this high, all right, which here's the 9:30 open right here. So we go up at 9:30, sweep this high, 1 minute back down. But why am I targeting down here? Well, trendline liquidity. Look at how engineered this was, right? See how we had the touch here, here, and now here where it was being respected. So now we have 3 touches there. I'm targeting this low from midnight. All right, that low from midnight. You're probably wondering, like in 2024, I would have been like, oh yeah, I'm just targeting this because it's the low from midnight. But in 2026, I'm targeting this because it's engineered stop losses. And we have more retail traders than ever trading, and they're all trading trend lines. And that's why you see all these trend lines being built up a lot longer today. But you can pretty much catch these good runs to these trendline liquidities built up overnight at or around open, or usually the first 30 minutes. Sometimes later, sometimes later sessions. But again, most of my trades are going for these engineered lows and highs. Okay. Now let me show you.
A really good point there. I think that reminds everyone, like, just don't take any fair value gap just because it's like a pattern that you've seen play out before. Like really study the charts like on a higher time frame, like the 15-minute time frame, and before the open. So like on Friday before the open, there was those equal lows. So actually not just 3 points of equal lows, there were actually 4 as well. So yeah, that's a really good sign, just to study the higher time frame charts before going into like the 1 minute chart before the open. It's a really good video so far.
An example of what I wouldn't target. This is a good trend line. So theoretically, if we, got, I would say this inverse here, I would target this. Okay, but we never got it, so I'm not going to take the trade. But what would I not target? I wouldn't target something like this. If we had a giant wick sweeping the high, that is not a trend line anymore. All this liquidity right here, and right here have been ran. So therefore, even if we did get that long, it would have been bad, and because it would have been irrelevant, right? There's no more stop losses here anymore, right? There's no more stops, right? And with that, this is going to be the end of the video. Test this strategy yourself. In 2026, I've definitely noticed a lot more engineer liquidity being built up, but it's okay because we can use that to our advantage. If you're going to buy a prop firm account and test this out, don't forget to use code Dodgy.
Good video by Dodgy there. It shows like trading is more of an art than science, especially during choppy conditions, and the price action of Nasdaq, especially a week before FOMC, has been a lot more like forex really, and you have to be a lot more patient and time your entries and look for the drawn liquidity. So uh, pretty good lesson there, and be more patient and plan your trades better.